Welcome to another episode of Value Investing webinar. This is brought to you by Value Research and Quantum Mutual Fund. Today we are going to talk about the often referred expression in value investing, which is the margin of safety. Benjamin Graham, once widely regarded as the father of value investing, once said that confronted with the challenge to distill the secret of sound investment into three words, we venture the motto, margin of safety. So it's an extremely useful concept for every investor and the most effective way to deal with the uncertainty of the stock market and the noise of the stock market, where all your hypotheses, all the actions that you have taken, everything that you have based your premise on is put to question once there is a market movement which is not in line with what you expected. So as an investor, how do you practice it? With me is Sorbh Gupta, Associate Fund Manager at Quantum Mutual Fund, to discuss this concept in greater detail. So welcome Sorbh to this special episode where we are talking only on margin of safety.
Thank you.
So what is your concept of margin of safety, the way you have understood it and practiced it?
So margin of safety actually is a very simple real world concept. To explain you with the help of an example, if you build a bridge which can carry a capacity of say 20 tons and you allow only 10 tons worth of weight of trucks passing through, you have built a margin of safety of about 10 tons. Similarly, a businessman doing a sales of 10,000 and having a cost of 6,000 has a margin of safety of 4,000. So that is the basic real world concept of margin of safety. Now practitioners of value investors have incorporated this concept very beautifully in whole value investing concept, straight from say Ben Graham, Seth Klarman, Warren Buffett, all have incorporated so well that this has become the central thesis of value investing. So basically value investing, so let us assume that I value a business for 1 rupee or say 100 rupee. If I buy it, so the value of that business can be 125 rupees or 75 rupees going forward. I don't know because it is future gazing. So am I comfortable buying it at 100 rupees or should I buy it at 75 rupees, thereby a 25 rupees margin of safety, in the sense that because it's future gazing and calculating the intrinsic value of a business itself is not a perfect science in itself, because there are a lot of assumptions, there could be analytical errors. To factor all this and mistakes, you have a margin of safety built into your investment decisions, and then definitely that reduces your risk and the possibility of making losses in your investment, because the primary focus of value investing is preservation of capital, and margin of safety is the central thesis to that.
So this complex thing, you explained that a lot of assumptions, things can go wrong and the environment can change. You have not that things go wrong, just that things. So how do you go about doing it?
Look, so there are two levels of margin of safety.
How do you calculate, the worth of a business, intrinsic worth of a business?
Sure. So within the margin of safety, there are two levels that we look at. One is margin of safety on the valuation side, and margin of safety while I project the business worth, the cash flows, etc. So coming to the numbers that we try to project for next 3 to 5 years, we are generally conservative in nature. We don't try to build a bull case. We will be closer to a conservative or a base case kind of number, and we'll try, in a cyclical business, we'll try to normalize the earnings and then look at the business, what its worth is. So that is one level of margin of safety that is well built in our numbers. Secondly is the valuation. So we would love to buy a company, ideally if available, at a 40% discount to long-term valuation medians. So that is our margin of safety assumptions. So there could be possibilities where a company in the worst of the business cycles or one of the worst of the market cycles have not come to those levels. So that is also a possibility. Factoring that, there could, and plus the management quality, the quality of business, it could vary a little, but ideally we would like to buy a company at a 40% discount to its long-term
median worth. Do you have anything which people can take away in terms of any precise parameters or looking at things? Of course, leaving the subjectivity aside.
Look, so then there will be different businesses where you look at different parameters. So for example, any business which is asset heavy, you should look at a discount to the asset value or the replacement value. That is one. I know a company which has a stable future cash flows. I can look at a present value of future cash flows, then apply a discount to that. So depending upon the sectors, etc., there will be different parameters. But then you can decide on your own what kind of risk that you want to take, and then you decide on a margin of safety on the intrinsic value that you have arrived for the company.
So this kind of conservative approach, does it not translate into a lot of missed opportunity? Because in a kind of market where the investor dynamics changing, a lot of Indian investors putting in, market is normally driven by two things. One is attractive valuation, but that apart, if a lot of investors are just moving to equity and in a very sustained period, over a sustained period of time, we will not get this opportunity. 40% discount to their intrinsic worth or long-term medium valuation. So what kind of regrets do you have?
Look, so as a fund house or a fund manager or a process, the one thing that every fund management team, keeping the philosophy aside, is to reduce your errors of commission and errors of omission. Basically, errors of commission is when you buy a stock and you made a mistake and you see losses on your portfolio. Errors of omission is where you don't buy a stock and stock moves up and you missed an opportunity. Value investing clearly focuses more on reducing the errors of commission.
Okay.
So preservation of capital.
Avoiding mistakes.
Yeah. So preservation of capital is definitely more important than returns. Returns are definitely important, but preservation of capital is more important. So the focus is to reduce the error of omission, but then to ensure that our margin of safety are not so high that the error of omission makes become too high that we get out of the market.
It gets difficult to invest itself in the first place.
Yeah. So definitely there are missed opportunities, but over longer periods of time, we have seen that most of the companies that we look into have come into our buy, we have bought them and we managed to sell them. So it's not that, so there could be pockets of period when the market is in a tearing bull market and people are not looking at the downside risk, and so 1.5, 2 years could be a time frame where we could underperform, we could not buy stocks. So that could be a possibility, but over longer periods of time, you definitely get into sweet spots where you can buy these stocks at your level of margin of safety.
When you are actually waiting patiently for a stock to fall and then it starts falling, then it sometimes gets into a free fall mode. How tough it gets executing the real transactions and trying to, because it could be an act of courage when things are in a free fall mode, and while you have done all the calculations and all the estimation and done the waiting patiently, how hard it gets emotionally or psychologically?
Look, so at that point in time, your very well defined processes really help you, right? So for any stock, we have a defined buy and a sell level based upon our definition of intrinsic value and margin of safety. When the stock hits a buy limit within our post our margin of safety band, we'll definitely go ahead and start to build our positions. If the stock continues to sell, so if it sells below our 20% of our buy limit, we'll definitely revisit our assumptions, go and meet the management again, retest our assumptions whether we are factoring something wrong or markets are factoring something right.
Okay.
If those assumptions are watertight, if the research is watertight, then we don't worry, we'll go ahead and continue to accumulate our positions, add to our positions.
So you reduce your risk by understanding things more.
Yeah, so definitely we have to go back to the table and we have to redo our research whether we are reading something wrong because market is factoring something and the stock is falling. But if we redo our research, we test our assumptions and meet the management and everything looks okay, we'll definitely have the courage to buy more.
And after you have done this exercise, assuming that a stock falls into a reasonable range of your buy targets, and then it gets into a free fall of a significant scale. How often this has happened and how do you deal with it?
Look, so these things can happen because your time horizon is a bit different, and
do you have any kind of stop loss on the value on the price?
we don't have a stop loss on a price. Our only way of looking at things, which things are not going our way, is go and do your research. That's how it is. And redefine the research, look at more parameters if you can factor in, meet more of the management, that's competition, do some channel checks, and retest and revalidate your assumptions. And if you are okay with the assumptions, then we stick our neck out. And
so just price is not the does not decide your decision, but the getting back to the fundamentals.
Absolutely. So until unless there is a change in the intrinsic value, depending upon my assumptions, until unless there is a change in intrinsic value, we will not change our thought process on buy and sell.
So going by this, margin of safety framework, what are the kind of missed opportunity of certain? Because if I think that if somebody is practicing this so intensely, how will a Google figure in funds portfolio or something which will not have a history, will not have a track record, will not have a 5-year median thing, hard to evaluate, and Amazon, Facebook and Google kind of businesses, where will they fit in, or will it be a completely missed opportunity?
I think they could largely be a missed opportunities. As you have seen globally, value investors have not done good in tech investing. So tech investing is more of a taking a future call and factoring in not just cash flows but some other metrics like gross merchandise value and stuff like that, and some fancy
some
stuff.
Nonsense like that too.
Some fancy stuff. So there could be a possibility of missing out some very high growth companies. That is definitely a possibility in the value investing framework.
Now we get on to the questions from our visitors on the website, the readers. Kushra is asking, generally how long do bouts of underperformance last for value funds? How long can you do poorly?
So it's very difficult to give a time frame, but I can tell you that till the time markets ignore to factor in downside risks in the investment environment, value investors can underperform, value funds can underperform. So a very good example which we often quote to investors is the period between 2006 and 2008. So that 2-3 years we underperformed because markets were in a tearing bull market with no respect to corporate governance, no respect to the current value of the business, and factoring too much future good news. So those are the periods where value investors tend to underperform. But over a period of time, both in terms of your CAGR returns and risk-adjusted returns, value managers and value funds will give you the kind of return that you are looking for.
You escape the downside much better.
Much better. So preservation of capital is much better. So definitely adjusted for risk, the returns are much superior. And even on a CAGR basis, the returns over a cycle of 2 or 3 cycles, the returns are very much in line than other funds, maybe better.
Payal is asking a very interesting question. Are there any sector-wise key indicators on how one must value a company's stock and look at its margin of safety, which you said in the initial part that you'll be looking at cyclical business differently,
right,
and consumer business differently. But do you have some kind of checklist?
No. So margin of safety is the comfort that you want to build into your investment, right? The way sector differentiates is where you value the intrinsic value basically. So for a cyclical business like cement, you might look at replacement value. Some other business, maybe real estate, if theoretically that can be come in a value, you should look at an NAV kind of thing. And for steady businesses like consumer staples or maybe consumer discretionary, you can look at a present value of cash flow. That's the way you differentiate between the intrinsic value of a company or a stock, and then post that the margin of safety is your comfort on that business. So definitely a cyclical business or a high risky business should have a higher margin of safety. Sectors like staples, like say consumer staples like FMCG, etc., where you know that the consistency of cash flow is much stable, you can play around with a little less margin of safety. So that's the difference.
That's a broad framework to follow.
Yes.
Why do certain stocks don't appreciate despite declaring excellent results, while some others go up in spite of poor results? Tough question.
Sure.
And it requires a detailed explanation that market is crazy in the short run, right? So, but you explain it.
Yeah. So a bit tricky one, but I will definitely try to explain this. So look, market reaction, stock price reaction sometimes do not react only to fundamentals. There are other things also, like for example, what is the people thinking on that result. So it's the expectation versus outperformance. So you might, on a standalone basis, that numbers might look very, very good, very, very strong or excellent, but maybe the stock prices have already factored that. Right? Over a period, over last 3-6 months, the price have been factoring, okay, the stock is, the multiples that the stock is trading at, it deserves to get that kind of result, otherwise it will tank. Similarly, a very under-owned stock can definitely, even with a slight outperformance, with a slight growth, can definitely give you a lot of return. So it is market expectations versus actuals, and not only the actuals.
And the dynamics of that specific stock, float, this,
absolutely,
that,
and the short-term traders' position in that stock and stuff like that. So
speculative position and their expectations. So.
Right.
If a stock is falling due to some bad news or rumors, how can one assess whether it has bottomed out and it would be the right time to buy it? Finding the bottom.
So for any long-term investor who has done his homework on a stock, bad news and rumors is actually a good news, and he could get into the stock at the price he wants to. Basically, at times it has worked wonders for us, wherein we know that over a long period of time the stock is worth something, and currently because of speculative positions or because of some bad news or rumors which are maybe short term in nature, but over a period the business is very, very sustainable and very strong. These could be opportunities to get your margin of safety and get into those stocks for a long term perspective.
This is one question which is from Shantanu. How do I assess whether my funds follow the value investment strategy or not? Maybe I'll take this question, the first part of it, and then you get into the detail. One is that, today after SEBI has done the reclassification exercise, at least for namesake, the people who are, because earlier they were part of the mainstream fund. Everybody was at his own free will to say that I'm a diversified equity fund and I follow a value strategy. Now they have slotted a fund in a value / contra, so to say. So everybody has stated that, everybody is claiming that this is my fund which will follow a value investing strategy. Now you tell me how should investors evaluate whether it is a value fund or whether it is pretending to be one. It's just another fund which is claiming that it's a value fund.
Yeah, so I can give you a few parameters which are published along with the monthly statements. So, for example, price to earnings, price to book value, etc. can help you understand. So a typical value fund will trade at a discount in terms of P multiple vis-a-vis its benchmark.
We'll have a portfolio.
Yeah, portfolio. So the portfolio P multiple should ideally be lower for sustained periods of time vis-a-vis its benchmark. Similarly, price to book should be lower. Your standard deviation should be lower. And since value investing is a bit long-term approach, the churn ratio should also be lower.
So portfolio turnover.
Portfolio turnover, simply speaking. So these are the few parameters that you can look into, and you can track it over a period, and you can gauge whether that fund or a fund manager is pretending to be value or is actually value.
Actually value. No, I would like to also tell the readers that on Value Research Online, you go to any specific fund page. In the portfolio tab, you will get these 4 things. Price to earning ratio of the fund versus the benchmark. PB based on the aggregate. So this is the weighted average price to book value, price to earning ratio, also the portfolio turnover in all this long-term data that we provide on each fund. So you can use that information to really evaluate whether a fund is a value or not. Now this is Ankesh is asking that I'm 20-year-old and beginner in stock market. I've been reading about the market for the past several months. Can you give me advice on how to proceed further? I am tempted to answer this question from Ankesh.
Sure.
One is that congratulations at 20-year-old and getting started. It's a great thought. There are different ways of doing it. But I don't know, Ankesh, what you are studying. If you are actually have done your BCom, preparing for your business education, or you're doing CA or something like that, you will have the time and inclination, and you have been initiated to understanding companies' financial results and things. I would urge you to, try long-term stock investing. And before you do that, put that money in a debt fund. Whatever money you are able to save, whatever money you are able to get from your parents, put that money in a debt fund. Have patience. Don't be in a hurry to invest it. And if you are none of these, if you're not into a profession like this, start with a balanced fund. That's a very simple way. If you're not interested, if you don't have the time, if you don't have the inclination to understand things further, do your regular investing in balanced fund. Do it for 1 or 2 years, and rest of the things will fall in place. Sanjeev has this question: can we draw cues from the portfolio of well-performing small and mid-cap mutual fund schemes regarding the likely multi-baggers of the future?
I would be a little circumspect on starting with that. You can definitely look at the portfolio and try to do your own research, but definitely fund managers who have build those positions, they would have their mindset in why they have put their positions into those stock, what's their time horizons. So blindly picking a stock because the fund managers added it in as a portfolio and buying it doesn't make sense. Definitely, if you are reading a lot of these monthly fact sheets and you see a lot of ideas coming in, you should do your own homework. You try to your whatever basic research you can do. At least the publicly available informations on the BSc website or the annual report or company press releases. You go through that. You should have that knack of understanding the businesses and how they will perform over the future, and then maybe you can look into those stocks. But only because a fund manager has bought it into a portfolio or added a position and going ahead of buying, I don't think so. It's a very wise thing to do.
Navroz has this question: is value investing? Now there's a big question. This is a question which everybody will be asking. Is value investing better than growth style of investing over a long term of 20 to 30 years?
So the way I would like to answer this question is there are two different philosophies. Definitely, over a longer periods of time, what is more important is consistency of return and preservation of capital. So ideally, value style of investing takes care of both these things. So for a longer periods of time, adjusting for risk, I think value funds should do well for you. But this also entails that what's the kind of ability and intent of the risk that the investor wants to take. If you believe that your ability and intent to take risk is higher and you want to go for growth and you want to take that chance, definitely you can create a portfolio of growth stock. And if you believe that your ability and intent to take risk is a bit lower and you want preservation of capital as a primary thing, but definitely you also want to have a good set of returns over a longer periods of time, you can go for a value kind of strategy from them. Ideally, I'm sure you would be in a better place to answer. A basket of strategy or a basket of fund is always a better approach for a retail investor than going whole hog into one kind of style, because there could be periods in your return requirement time frame where certain funds would outperform, and then you could have a lot of hard burns doing it. So a balanced approach would definitely help you as a retail investor. You can
I would just like to supplement it that just to understand at a very outset the comparison of the two strategy. The value manager, like the one sitting right in front of me, is trying to find quality businesses which are available cheap. That does not necessarily mean that they are not growth businesses. There is a possibility that those he's factoring in the growth potential of the business, just that he's looking at a price point where it's also available at a discount to its long-term valuations. As compared to a pure growth fund manager will be looking at companies which are willing to pay a huge premium for the rapidly growing, the great growth in a company, and he's willing to pay that premium on the assumption that this will continue to grow in some foreseeable future, and he's trying to factor that. That growth strategy works very well when things do work out nicely as expected. But whenever there is a small disruption or there is a little apprehension or some interim result, it causes a lot of heartburn, because the great disappointment that is caused by the things not materializing the way it was expected, it turns out to be painful, and that causes panic. So that is why you see if you look at the category returns of the large cap fund, mid cap fund, small cap fund, 10-year, 15-year, 20-year period, even the small caps do well. Even the value funds have done reasonably well. But if you look at the intermittent decline of some of those funds, they turn out to be extreme. Just to cite you an example, in 2008, the market tanked. So the small cap funds went down in value by an average 70%, while the diversified equity fund fell by 45%. Even your fund would have fallen by 45%.
Right.
So, and their ability to recover, because some of those hypotheses, when they go wrong and if they are unable to, they turn out to be grossly wrong, they just go into the pits. So that is a risk which you are taking. And to secure yourself against this, as he said, diversify. Not one strategy works all the time, and then try and after 4 or 5 years of investing, people figure out what they are comfortable with. You can be a pure value, pure growth investor after you understand that what you can withstand. So
just to add on, absolutely. So this misconception, I think you very well pulled it out, that the value managers don't like growth. That's not the case. It's only the difference is that what kind of premium I want to pay for that growth. So there could be a possibility that I get the similar margin of safety in a bad market, and I can buy into a company which is growing very fast. So I'll definitely like to go and buy it. So this popular misconception of value managers not looking at growth.
They're not mutually exclusive as such.
Absolutely.
They overlap.
Right.
In the last 2 years, this is a question from Subhash. In the last 2 years, I have gradually moved my savings from fixed deposits to equity mutual funds. Can I expect a return of 15%?
So, as SEBI bars us to promise you a return, but I can tell you how to look at the returns from equity. So if you look at India's GDP, longer periods of time, 15-20%, average GDP growth has been 6.5%, and the inflation is about 5.5%. So nominal GDP grows at 11-12%. That could be ideally the sales growth of a well-managed company. Theoretically, that thumb rule is that it will grow as per GDP. And a well-managed company can gain market share, it can improve its margin. So ideally, its profit growth can be between 14 to 15%, assuming that which company, which sector you buy. And assuming that there is no PE change as such, and not factoring these PE changes, this should be ideally your growth in the stock prices.
And then there will be leverage.
Definitely.
If you look at in the company, expanding companies,
Right.
expanding growth.
So 15% growth based upon that logic that I told you should be a possibility over longer periods of time in equity.
Mm-hmm. Yeah, I agree that, but the real way of looking at, instead of expecting a precise 15%, these numbers are actually moving variables. For example, if the fixed income return in this country is 10%, 15% return from equity is very low. So we are getting down to a point, where if your fixed deposit would have yielded 7%, or 8.25% today, but it is well on its way to be yielding only 6% or 6.5% in future. So in that case, 100% premium on that fixed deposit return, and then relatively superior tax efficiency, because your return from fixed deposit will be completely taxable. It will be added to your income and you will be taxed at the marginal rate, whereas return from equity will be taxed at 10%, capital gains will be taxed at 10%, so that is beneficial. But that apart, if in US, where the fixed income returns are very low, 1 or 2%, 10% return generated by Warren Buffett over a sustained long period of time looks like a great thing.
Right.
In India, the risk-free return used to be 10%. So the 10%, 15%, 17%, it is all a function of where we exist and the environment. It's a relative thing. Now, the final questions looks like comes for me. Baldev is asking, what should be the criteria while choosing a tax-saving mutual fund? The criteria for choosing any mutual fund, any equity fund, is that look at its performance over a full market cycle. Look at the performance of, and if the fund manager is still there, and has the fund manager followed what he has stated to be. And consistency of return matters. Little less in tax saving fund, because once you invest, you are not, because for individual investors who are getting excited or getting anxious with their performance of their fund, you can because you invest in a tax saving fund, get logged in for 3 years, and mostly it turns out to be a pleasant experience with a 3-year holding period. So thank you, Sorbh, for being here. Though the set of questions, there are quite a few for me, and I took the liberty of answering them.
Sure.
So wish you very best, and thank you for sharing all the great insights with us.
Thank you.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.